When it comes to paying less taxes in retirement, a well-organized Roth conversion strategy can save us hundreds of thousands, if not millions of dollars in taxes over the course of our lifetime. But what does a Roth conversion mean? And how does it work? Well, let's jump right in and find out. Welcome to another episode of A Worthwhile Retirement. I am Jacob George. If you didn't know this already, at the very end of these episodes, I have a short little disclaimer. And today's topic in particular has inspired me to start moving that up to right now. And so, it is important to note that while I am a financial planner, I am not your financial planner. And so the information that I talk about here shouldn't be taken as personal investment, legal, or tax advice specific to your situation, because I don't know your situation. So just be sure to consult with somebody who does before making any major changes to your financial plan based on what you hear today. All right. So today we talk about one of my favorite topics, Roth conversions. And it first earned its spot as one of my favorite topics because of the impact it can make to your financial situation. In fact, I've recorded a short YouTube video to illustrate how significant of a difference that Roth conversions can make to somebody's financial plan. The link to this video is in the description for this episode. I encourage you to give it a look to hopefully ingrain in all of us how important this topic is. And so, let's get started. If you're familiar with the retirement planning space, you've probably heard the term Roth conversions thrown around here and there. But what does that actually mean? And why on earth are they so very popular? Well, a Roth conversion is simply the process of moving money that is currently in your pre-tax traditional accounts into your after-tax or Roth accounts. So we're just taking funds that you haven't yet paid taxes on, rehoming them into an after-tax or Roth account, and paying the taxes on them in the year that you made that conversion. Simple enough. But why would we ever want to do that? What's the big deal with whether I convert or not? For those who have a significant amount of assets and pre-tax accounts, such as a traditional 401k or IRA, then a Roth conversion strategy could prevent you from overpaying hundreds of thousands of dollars in taxes over the course of your lifetime. You see, whenever you look at the overall balance of your pre-tax accounts at that dollar amount, it is important to recognize that not all of that money belongs to you. Some of it belongs to the IRS, and they will force you to give it to them, either on your terms or theirs. Because once you reach a certain age, right now the age of 73, the IRS will force you to begin draining your pre-tax investment accounts by what we know as RMDs, or required minimum distributions. And by forcing you to make these withdrawals each year, they're also forcing you to incur the tax liability for these withdrawals each year as well. And this is all happening whether you need the money or not. Which brings us to point number one. Roth conversions give you more control to make distributions on your own terms. And making distributions on your own terms generally means paying taxes during years that your income puts you in a lower tax bracket, such as after you've retired, but before your RMDs kick in, or maybe even before Social Security kicks in. Which brings me to point number two. Your 70s aren't a great time in life to be experiencing additional taxable income. We've mentioned this before, but your adjusted gross income influences how much of your Social Security benefits are taxed. For example, in 2024, a couple with combined income over $44,000, married filing jointly, could experience up to 85% of their benefits to be included in their taxable income. So if we can help it, we do not want to be forced into a situation in which we're drawing income that we may or may not need, paying taxes on that income, and having that event further increase the taxes we pay on our Social Security benefits. And Roth conversions can help us limit that liability. And point number 3, Roth conversions make your assets more easily inherited by your heirs. The after-tax Roth assets that we leave behind will not be taxable to our beneficiaries. And of course, those assets will even continue to grow tax-free. But on the flip side of that, when it comes to our pre-tax accounts, somebody will have to pay taxes on those assets eventually. Whatever pre-tax assets you leave behind, your heirs will have 10 years to deplete those accounts, paying all the taxes along the way. Just imagine if they were still in their high income working years, what that could do to their tax bracket. As we convert pre-tax assets into a Roth, we can reduce that liability to our heirs. All right, so because somebody will be paying taxes on our pre-tax assets at some point, we ought to evaluate when the best time to pay those taxes would be. And that is what a Roth conversion strategy is for. How can I take this lump sum of pre-tax investments and distribute it in a way where I pay as little tax as possible? If you would like to see an example, again, check out the episode description to see how much of a difference that Roth conversions can make when it comes to reducing your tax liability. Because implementing a strategy like this can mean the difference of hundreds of thousands, if not millions of dollars in our pocket, rather than in the pocket of the IRS. And I am confident that if you're listening to this podcast, that you would be a better steward with those funds. Thanks for listening, and I'll see you next time.